Hey everybody, welcome to Trading Capital's Daily Analysis video. I'm your head market analyst here, Curtis Gowden. Jumping into the charts on this December 28th. So today was a little bit of a higher volume session than yesterday. And what we saw today was pressure in the overall markets. Basically, tech was leading this to the downside on the QQQ or the NASDAQ via the likes of Apple. But then you did see strength in names that were extremely beaten down like Tesla. But looking over the S&P 500 here, it was pretty much a very broad-based sell-off today, but it was very contained. If you look at the daily chart, we're still putting in this bearish consolidation under key moving averages. In my mind, this pattern that you've had a sharp sell-off with a minimal bounce, rejection at the 50-day moving average, kind of rejection at this previous support level, which is now resistance. In my mind, going into tomorrow's initial job loss claims, I believe at 8:30 a.m., I think that the markets are poised to continue to see some downside pressure. Now, being the fact that it is still the holiday period and there's big traders away, we could see a little less volume than we usually do. However, if that jobs number comes in better than expected, meaning that more jobs were created, then that certainly isn't going to favor the likes of interest rates pulling back or yield softening. It certainly will light a fire under yields if that jobs number comes in better than expected. So we'll just have to wait and see how the markets digest that data tomorrow, I believe at 8:30 a.m. But looking at the S&P, right now you're really not trading in any major or minor or intermediate support. You're kind of just floating in no man's land. There's still a major technical gap around 372. Actually, I would have to rephrase this. This is no longer a major technical gap considering that you've consolidated. This is more of an intermediate gap. Yes, you're still short-term slightly oversold, but this bearish consolidation for about a week isn't helping situations. And considering that you consolidated right over that gap, it does favor that you still get a bounce off of that level, maybe intraday, but it could slice through that level off of bad data. Bad economic data. So that's kind of what I'm anticipating. Now you do have a second level that you can watch. Basically what I'm thinking is that if we get data that is worse than expected, we could see a sharp sell-off right down into this area over here. I do think that would provide a good level of support for potentially a bounce. You do have these previous June pivots over here, as well as you would fill this major technical gap, but you would have the retrace back to the breakout zone, and you would have this major upsloping trend line from the COVID low to your low point over here. And then that begs the question, starts to shape up, are we creating a larger bullish pattern here potentially to move up for a larger rally, maybe testing back up to the 400 level? These markets I do think will go down, but perhaps heading into the January effect after tax loss selling, there may be an inflow of capital into the markets, but we'll just have to take it candle by candle. Looking at the QQQ, you can clearly see the relative weakness. Let me just erase some of these lines here, just so it's a little more clear. But you can clearly see the relative weakness on the Qs. Basically, Qs have had a sharp seller from 296. This has been due to Tesla, Apple's starting to break down, and Apple's actually really interesting chart because if that starts to break down even more, that's going to be a major headwind to the overall market. So we have to really identify the trend for Apple and where it's likely going to go, because if Apple's down, it's very rare that the market is also positive or closes positive when the biggest company in the world is down on the day. So let's just continue to monitor Apple. But the Qs, sharp sell-off. You have filled this technical gap. This one, you basically are at some pretty decent support right now, I would say. So maybe there is the potential for a bounce. And that would kind of align with the expectations that Tesla is extremely oversold. You have Amazon that's oversold. Google's oversold in the short term. So there are stocks that could potentially diverge and have a little bit of a bounce. Just like the kind of this Q indices here. But again, if the Qs continue to see weakness in Apple, then that doesn't favor a bounce in the Qs. It may mean that we have a straight shot all the way down to here. And let me be clear, if the yields spike tomorrow off of a better than expected jobs number, then we could see the Qs come all the way down to this double bottom, which I will look to start accumulating more long positions. Looking at the DXY, why I'm so kind of pessimistic on this market is because the markets have sold off pretty decently, but you've only just started having the dollar break out of this downsloping wedge pattern. We were talking about the series of higher lows on the dollar, and that certainly looks to be coming to fruition now with the potential confirmed breakout on tomorrow. Basically, how things are shaping up with the rally in yields, the rally in the dollar, it's looking very, very likely that we do see a number from that jobs number that does not align with what the market wants. So potentially we could have a confirmed breakout on the dollar, which would likely send it to the top end of this range, or even at the minimum a retrace back to this original trend line around 105.70-ish, give or take. So I do think that if the dollar continues to push up, that again is once again another headwind. And one of the reasons I was watching intraday on the dollar is as you had the dollar rallying intraday, you actually had an inverse move in the markets. So if we flip back to the SPY, you can clearly see this, that inverse relationship to the dollar. That's why we sold off today, was I believe primarily due to the dollar. Just if you overlay those two patterns, they're pretty much inverse. So again, if the dollar is potentially breaking out in the short term on the daily chart, then that certainly doesn't bode well for stocks and most of the commodities sector as well, which is one of the reasons why we're also a little slightly bearish in the short term on silver and precious metals. We're not shorting gold, but we are shorting the SLV. We're still at that 2230 level, but you can clearly see I'm anticipating a larger pullback, at least to the minimum, to this 2060 level or 2062 level, give or take a penny or two there. Let me just see if there's anything else I can touch base on. Basically, if we look at the yields, here's the 10-year, boom, massive surge. 20-year, massive surge. Obviously, we're long UBT. I would love to see the 20-year come up and fill this gap over here. That's kind of what I'm waiting for. I did have an alert anticipating that we do fill that gap. It just missed that penny by pennies. So in my mind, when you come this close to a gap, technically a daily gap too, you are likely going to see it filled sometime in the next few days. And that could be on the spike of that jobs number, or into. So it's very likely that you see that gap filled in the next few days. That could be on the spike of that jobs number. We will just have to wait and see. Let's take a look at the 2 years. Since the long ends were rising and the short ends weren't, it's really displaying that the Fed doesn't want to take their interest rate hiking above the this level 4.25, which is what they're currently at. So there's a small divergence between what the bond market is pricing in and what the Fed is currently at. The Fed is currently at 4.25, and basically the bond market is at 4.35. So a very minimal difference. But again, the 2 year should be softening as the long ends rise, because that starts to uninvert the yield curve, and maybe rates will just be pinned higher for a longer period of time. And that certainly would not bode well for any of the growth stocks as well, especially if rates do stay and chop in these higher ranges for a longer period of time. And if you have the short end just staying at this level, it's creating a ton of damage to basically growth and high debted companies. But if you look at the long ends, once those start to continue to rise as well and catch up and uninvert from the 2 year, that puts the tremendous amount of pressure on the largest asset class in the world, which is the real estate market. And once the real estate market starts to break and soften, that's when things are going to be very, very interesting. And that's when you likely see the uptick in the unemployment rate, which is currently still very, very low. Really, that sums it up for today's video. I mean, we can touch base on oil. Oil was down on the day, about 1.47%. So that's pretty interesting to see. Let me just flip to this oil chart. I think it's slightly different. Yeah, so I'm going to use major resistance, this red trend line over here. That's the big level to get through. If you can close above that and confirm, you likely head to the top of this channel, and then eventually the top of this channel if you're on the bull side. Now, if you're on the bear side, which I'm slightly leaning towards just due to this overall trend here, and considering that you haven't really broken out of any of the intermediate or minor trend or major trends, I still think that we could see $67 in the near term, sometime in probably the first quarter of 2023. So that's basically within the next 3 to 4 months. I would anticipate that we could see $67. And then after that, I would actually be looking to go long oil. You're basically retracing this whole broadening formation pattern. You've had a pretty tremendous sell-off, and perhaps it does correlate at these levels where the Strategic Petroleum Reserve becomes the net buyers instead of net sellers. So that's kind of my expectations for oil. But if you analyze each sector, there's a lot of distribution occurring. Yes, it is on light volume, but if the data certainly comes in hotter than expected, which is perhaps what the bond market is also signaling. I mean, we warned you of these long end yields breaking out quite a while ago, right from this downsloping channel over here, which we got our confirmation, beautiful consolidation, and look at that move. And that's certainly a problem for the markets, which I don't think many and all stocks have adjusted at. There certainly have been a lot of stocks that have adjusted to this interest rate breakout and yield breakout. But let's just be clear that some stocks haven't, and that's certainly maybe what we're starting to see. But overall, let's take a look at a peek at Tesla quickly. Tesla is having a little bit of a bounce today. It was up when the markets were down, so Tesla was up 3.3%. That is extremely good to see, especially when the indices are down. When you have the QQQ down basically 1.3%, and the S&P down 1.2%, and the Russell down 1.5%, silver down, gold down, and then you have Tesla making a beautiful divergence. That's awesome to see, and that is expected at these major support levels. And when you look at Tesla's volume, I mean, we just crushed it again, 218. I didn't think we were going to get bigger volume traded than this last candle here, this 210, but we got a bigger one. That is incredible to see. Certainly an epic price action. I'm glad that we added down there. Even if Tesla goes lower to this 100 level, that's the next big technical level to add to our position to. I have no problem adding there and really increasing the exposure and kind of maxing out that trade for where it is. But I'm comfortable with what Tesla is doing today, especially diverging positively from the market. Now, I do think that there's still a lot of work for Tesla to get basically outside of this wide range red bar, but being the fact that it's a positive day on an extremely amount of high volume shows that there were an extreme amount of sellers that were still selling into this market. However, the buyers were very confident level and started picking up those shares and actually overpowered a market that was down on the day. So a short-term positive sign for Tesla, I think so. Obviously, we're biased because we're holding the position to the long. But again, just a simple minimum retrace takes you back to about 130 on the charts. And even I think you could retrace a greater deal, potentially up to this 166 max level. But let's just continue to wait and see how it performs. Even if the markets get a positive day in the near term, perhaps it's more of a January effect play where Tesla gets a massive bounce. We could likely see a bounce heading into the January New Year period as a lot of tax loss selling has occurred. And you have to remember, Tesla was holding up fairly well into the new year or into 2022. So it was actually a growth stock that was holding up compared to the market, outperforming the market. And then come September, obviously when Elon announced the Twitter deal, it just started imploding, and it just never stopped. But in terms of where Tesla is compared to the market now, Tesla is actually extremely oversold in comparison to where the S&P is. So I do think that we should see some positive strength moving forward, just due to the fact that it looks like margin selling is coming to an end, as well as the tax loss selling for Tesla now. Obviously, if there's a bad CPI number or a bad jobs number tomorrow, it will put pressure on Tesla, but I do think we're getting close to a near-term bottom. You're at major support, and there is good accumulation occurring intraday. That's it for today's analysis. Please give this video a big like down below, and we will see you on the charts. Members, be ready for a crazy potential day tomorrow. Everything hinges on this economic data release, so I will be trading live, sending out alerts, managing the positions that we are taking, and basically providing any insights that I think are worthy of sharing intraday or at the